Hello, everybody, and welcome to a new video in the channel. This is more of a, I guess, a rant style video. I guess I don't know, but I have a lot of things to say about 2022, and so it will differ from my more focused stock videos. But this is kind of the vision that I have for the channel, and so I have to talk about this because this is so crazy. The 2022, what's happened in 2022 is just beyond crazy. And so I ask this video, I start by asking the question, did you survive 2022? If so, you should be very proud. I survived 2022. And if you were invested in 2020, by the way, congratulations, you survived like twice, two events, which really should be once in a 30 year or once in a 50-year event. You got two of them in 3 years, and you survived both of them. So congratulations. You should be very proud. I know people who are like, okay, I'm just gonna sell everything and I'm just going to buy bonds, or I'm just going to like I don't know, put money under a mattress. So you should be very proud. I mean, and I'm talking about also like selling and getting out of the market. It's different if you're selling to tax loss harvest and to tax loss harvesting. But as the end of the year approaches, I was thinking of what is a song that could represent the year, and I don't know if you're familiar with this American history thing, but it's called "The Day the Music Died," which we had this great era of rock and roll that started out, and all of a sudden you have a plane crash, and all of the artists of the day die. And I kind of feel like this year was the year the market died, which is like we have all of these companies that really were innovative years in the making that go public in 2021, very innovative stuff. And I mean, I don't think they're dead. I think they're going to make a comeback. Very much think so. But right now they're left for dead by the market, even though they have all of this amazing innovation. And so this is a bit how I felt about so many innovative companies being bashed by the market for no reasons. I listen to a lot of conference calls, and it's a little pathetic. Like you have a lot of analysts who are like, "Oh, are you going to be profitable next quarter? Next quarter? Like when are you going to be profitable?" Like you have a CEO telling the analyst about the revolutions brewing within the company, all of the great stuff going on by the company, but just because it's not next quarter, just because it's happening 2 years from now, the analysts are downgrading the stocks, they're bashing the stocks, and they're pressuring these CEOs and these top managers, they're pressuring them to do short-term investments. By the way, with a position that they mostly don't have, right? That position they have because of institutional ownership, right? They represent institutional shareholders, which are mostly inactive, right? It's just retirement accounts. Like, anyways, I have a very strong thought about this. This is a video I made recently about that. Is like the analysts, the short-term thinkers are pressuring these companies to drop innovative investments. And so you have Facebook recently was pressured to drop the metaverse, and so they're going away from the metaverse. And the market is all happy because next year and the next year after are going to be so good. But the company forgets about innovation for the next 10 years, and same for self-driving cars, right? So many companies divested. 2 weeks ago, I believe it was Apple. Apple was divesting its self-driving car project until 2025. So many companies are moving away from innovation because analysts are making these short-term claims because of QT right now. Short-term horizons have become so tiny because of QT, and and people think in terms of legacy finance. Finance is a field that needs to be reformed. It's legacy finance. When you're thinking short-term and you're like, okay, yeah, bonds are going up, so you should put money into bonds. That's really the thinking. I mean, it's kind of crazy. Or there's gonna be a bump in the economy next year. There's going to be a recession for 18 months. So let's go ahead and let's sell revolutionary companies because the revolution is 5 years away or 10 years away. Anyways, it's more of a personal rant or statement here. But anyways, so what happened in 2022, right? Well, we all know what happened. It's the Fed, a single unelected official. It's always important to remind that, who said back not that long ago, said, "Oh, we're not even thinking about thinking about raising rates. And this is an article from a financial advisor I found who was like, hey, yeah, the Fed's not raising interest rate. Look at what Powell said. They're not even thinking about raising rates. And so companies listened to that and they were like, okay, we're going to have investor support. We're going to get Wall Street support. Wall Street likes innovations. All these companies invested, they hired, they did their IPOs, they expanded, thinking they have Wall Street support. The economy booms, right? When you invest, when you expand, when you do IPO, there's a booming economy. 401ks are up. People are happy. It's positivity. And then again, of course, Jay Powell got reconfirmed. And as soon as Jay Powell gets reconfirmed, right, you're not going to lose your job. What happens is this. This is what happens after he got reconfirmed. The quickest rate hike cycle in the history of rate hike cycles. There's never ever been a quickest one. And this is how fast we've risen rates in a matter of 7 or 8 months. So we in 8 months we've risen rates as high as say 3 or 4 years back in 2015, or as say 2 years back in 2004. So the problem is the market panics, right? The market panicked. The market did not see it coming. The market did not adapt. And since the market has short-term thinking and they hear this stern talk, Mr. Market is very irrational. Mr. Market is like, oh my gosh, I'm going to sell my stock because look at how stern Powell is, entirely forgetting that the word of the year prior was, oh, we're not thinking about raising rates. So you put credit into that language and you go ahead and pump the economy because you trust the Fed, and then the Fed changes their mind, does the quickest rate hike in history, and you trust them again when you say they're going to keep raising rates and the rates are going to keep being high. Well, I don't think the rates are gonna be that high for that long. I think they're gonna have to do QE very quickly, very quickly. I think this is a bluff. This is a bluffing because the Fed is stuck in a corner with its mandate where they have to deal with both low rates of unemployment and both low inflation as measured by CPI, which is a flawed measure, but that's a topic for another video. And so this is my viewpoint as to what happened in 2022, what the Fed's trying to do, and why it is so wrong to assume that innovation is dead. Innovation is not dead. Growth is not dead. Growth is just starting. It's just the beginning. So my viewpoint is that the Fed is trying to knock out the economy, like a literally knockout, like that. There's a video on Twitter that goes around about a woman who after a fight. Anyways, they're trying to knock out the economy. And so they do that because they need to stop inflation, but they can't have rates for so long. Like you can't have rates for as long as you did in the 2010s or in the 80s. You can't maintain rates this high because if you do, the government can't finance the deficit. Companies can't roll over their debt. Households can't roll over their debt if they do. And the system collapses. You have financial Armageddon, right? So you can't do that. The level of debt in the economy is just too high today for the Fed to keep interest rates high. But it could perhaps maybe handle very quick rate hikes. So that's what the Fed is doing to stop inflation. They're trying to create, in my opinion, a very swift economic crisis that lasts, 2 quarters, 3 quarters, so that the demand for goods and services drops, which again is a Keynesian assumption because in the school of thought that I identify myself with, which is Austrian, the relationship between money in the system and demand for goods or services is very tenuous, in my opinion. You're going to eat food regardless on how much money there is in the system. Anyway, that's for a different discussion. And the increases have to be quick because you can't have the rates too long for a long time, because if you do, who's going to buy those bonds when the government issues new treasuries? And all sectors of the economy are over indebted, so they're not going to be able to pay the new interest rates. They're not going to be able to refinance. Nobody's going to be bidding on that debt. and you can have a systemic collapse of the fiat system. Therefore, what happened from that knockout that we've had, right? The huge rate, this cycle right here. What happened? What happened from that knockout? Like, what is it that happened? Well, inflation is barely down. I mean, it's down a little bit, but it's barely down, um, which means that really, I mean, really, this hasn't worked. And M2 as well. M2 is barely down. It's barely down. And so keep in mind, they started these rate increases, what, 8, 9 months ago? And you're seeing inflation go down. But my argument here is that inflation is not going down because of interest rate hikes. Inflation, to me, is going down because these inflation problems were mostly supply driven. They're mostly problem with the supply. And so inflation's coming down. Why? Because all these companies overstocked and they have too much stock and now they need to raise their prices. Like, I really don't think the Fed needed to have created a huge economic crisis for the prices to go down. I mean, sure, perhaps they wanted to be safe, but I don't think they should have done that because they're not addressing the problem. They're not addressing the fundamental problem. They're bluffing. It's a bluff because we're going to have to start QE again. Like, if you want to address the fundamental problem, you need to go after, first of all, the government deficit and stop that deficit, then repay the debt, and then the commercial banking system has to be reformed because that's how monetary inflation comes, because of monetary creation, because loans create deposits and not vice versa. So they're kind of stuck in the middle. They're doing something that is stuck in the middle. Like, anyways. And is M2 down? That's a joke, right? The Fed has been trying to unload funds from its balance sheet. They've been trying to be net sellers. But who's buying these treasuries that the Fed is selling? Who's buying these mortgage-backed securities that the Fed is selling? The Fed has had trouble reducing the balance sheet. So even though they're doing QE and they're speaking a lot of big words, my argument is that they can't do QE because there's going to be tremendous problems if they keep going. Namely, who's going to buy those treasuries from the government in 2023 when receipts are going to be so low for taxes? Who's going to be buying those treasuries? Are they going to bring back the platinum coin idea? You're going to have the U.S. Mint print a platinum coin to buy the deficit. Is that something they're going to do? I mean, anyways, so I think we're going to run into problems, and the Fed is going to have to turn back on QE. But I've made a lot of videos about that in the channel, and I can point them into the description. So let's talk, though, about the effect of this kind of bluffing monetary policy where, you're not even they're not, like, even if they were serious about solving CPI, you would think they would raise rates above inflation, above CPI. But you can't even do that. I mean, if you do that, you have bankruptcies galore of governments, local governments, of perhaps the federal government, because nobody would buy that. The Fed would have to resume QE to buy those treasuries, and of so many companies in the S&P 500. So you can't do that. You can't do that. They're stuck. They're stuck in a corner, and they're acting like they're not. This is what this is. Anyways, let's look at the impact of short-term thinking, i.e. the Fed, on innovation. So Wall Street is now like panicking and be like, Mr. Market essentially is panicking and saying, oh, well, all these awful things are going to happen. The world's coming to an end. We need to buy bonds. Bonds are great again. Allocate to bonds. And don't forget, stocks trades at the margin. They always trade at the margin. So that's why it's sentiment that impacts stock prices more than anything in the short term. So look at this. Amazon down. They've been flat since 2018 roughly, but they were down 51 or 52% from peak. Same. Netflix, they've been flat. Tesla lost more than 50% from peak, and they've been really flat for about 2 years. And the reason why I take these companies and not broader indices is because I believe a lot of companies in broader indices are going to go bankrupt. And so it wouldn't make sense for me to assess indices with companies that are not going to go bankrupt. I'm assessing companies here that I think are absolute leaders in their respective market, whether we like it or not. So does it make sense for these stocks to be down that much? And the answer to that, in my humble opinion, is absolutely not. Amazon is still disrupting commerce. I mean, they're still at about 30%. I believe most commerce that is not experiential is going to move online. Amazon going to have a substantial market share. They have a huge demand ahead of them, right? And they're disrupting computing too. At current valuation, Amazon to me values either one or the other, but it doesn't value both. Like at current valuation, it's just insane. $900 billion for Amazon Web Services alone. That would not be far fetched, given how pervasive that company. Like few companies that we love in the modern world do not rely on AWS mixed with Azure or with GCP. They just don't. Like these companies run everything. AWS runs Netflix, right? Netflix is on AWS, and I could go on. Name an app. Name any company that's online that you ask. They run on Amazon. Same for small businesses. So it's like that's still happening. Amazon has no reason to be down 50% except short-term madness of Mr. Market. Netflix is still disrupting linear TV. Linear TV is well on its way to disruption in the US, but it keeps disrupting linear TV. So again, I don't invest in Netflix, but I don't deny that they're a leader and they've been one of the best investments. Tesla still disrupting the transportation sector. That hasn't changed. That has absolutely not changed. And so this is just crazy that these companies are punished while the present value of their future cash flows has not changed. What has changed is perhaps just a tad, just a little bit, the cash flows for the next year. That is the only thing that has changed. Like in 10 years, each of these companies will be much bigger than they are today. So much bigger. So much bigger. These are solid companies. Like Netflix was down more than 75% at one point. Anyways, let me show you another thing. Oil is doing well, right? Oil is doing so well. Oil is up. Oil is a commodity, so you can't really print a commodity like the US dollar. And so there's also war and stuff. So oil is up. Oil is a good investment, right? That's what Wall Street thinks. Wall Street has been bidding up the prices of oil. Like I don't understand it. Wall Street has been bidding up the prices of oil, thinking about this year, thinking about next year. They're like, oh, they're going to make a lot of profits next year. Let's bid it up. The biggest anomaly of the past 3 months to me was Tootsie Roll. Tootsie Roll Industries, I don't know if you know Tootsie Roll, it's American candy. Tootsie Roll was trading at 40 times earnings a few days before Halloween. Why? And I swear there were articles. Because the market was hoping that candy sales would be good for Halloween. That is how short term the market is right now. They are bidding up Tootsie Roll because they think that candy sales are going to be good for Halloween. And yet you have companies like Facebook trading at 7 times earnings, while they have a monopoly and they have a fighting chance against TikTok. Anyways, it's insane. It's absolutely insane. So zoom out. Zoom out is what I would say to people buying stocks in the energy market. It's like if you zoom out, like to me, ever since 2007, this is essentially flat. Like if you're to average out those gains, they're essentially flat. Okay, went up a little bit from 2002, but I have no doubt we're gonna get down. We're going to get back here. No, oil is the next coal. Coal today is gone. Coal is gone. So coal disrupted wood, right? Before coal, we had wood burning stoves and stuff. Then we had coal, and then we had oil, and now we have renewable energy, mostly solar. I want to emphasize that I don't know as much about wind turbines. I believe in solar. I'm a big believer in solar energy, mostly solar. And look at NextEra Energy. NextEra Energy, which is the biggest solar utility out there, only focused on renewables, has had outstanding returns. Outstanding, absolutely outstanding return. Well, it got killed this year too. But absolutely outstanding returns. Because that is the future. because today there is no electricity cheaper than photovoltaic energy. There is no energy cheaper than that. It just doesn't exist. And I've made a lot of videos about that. I've made a lot of videos about that. I know. I realize that I'm early saying that when I see the comments, because I have a lot of people telling me I'm wrong. That's okay. That's okay. That's how you know that people telling you you're wrong is great, because when you innovate in disruption, you are necessarily going against the trend. You're going against the establishment of what people think. So, what is my viewpoint? My viewpoint is revolutions are still happening. For example, I was talking about photovoltaic, which I think is one of the next revolutions. I have a video on end phase where I talk about it. I talk about it quite a bit, actually. Photovoltaic energy is still the cheapest energy in mankind history. There has never been a cheaper energy. The solar array you need on your roof to power your electric car and to power your whole house, in the winter included, is not that big. The efficiency of solar panels is leaps and bounds ahead compared to what it was 3 years ago. And by the way, it is leaps and bounds cheaper compared to what it was 3 years ago, because it has insane declining cost curves. And just because you have rent seeking from a few photovoltaic installers who charge a fortune and take advantage of people doesn't mean that this is going to happen forever. In fact, there's a lot of solar installers who do not take advantage of people. So, anyways, the environment impact also, and this is something you'll find in my video. I typically never talk about the environment impact because, well, first of all, because you can make an argument against it, because you're manufacturing something. So whenever something is environmental friendly, if you're manufacturing it, you have to take that into account. But also, to me, any of the what some people call like the green revolution, to me, the main driver of this revolution is the technology. It is not. I mean, the environment is not the driver. Like people are economic agents. They're homo economicus. They're gonna buy a product because that product saves them money, because that product makes them more productive. That is why people buy products, and that's the main driver of this revolution. When a 350 watt solar panel costs, I think, just under 130 bucks, $130 for a 330 watt solar panels. Do the math. Do the math on your own. Just read an easy web page on electricity and how electricity works, and do the calculation, and you'll be very surprised by how cheap it is. Namely, less than $10,000 to power your whole house with solar panels. And those cost curves are declining so fast. Solar panels are manufactured in giant factories that just throw them out, second after second after second. You have thousands and thousands of them. It is the technology. Same for battery. Anyways, there's colliding, declining cost curves that drive this entire revolution. This is an entire revolution. Another revolution, and there's many more, but I'm just going to talk about a few. Another revolution is AI training costs. AI training costs are decreasing at an alarming pace. I have bookmarked ChatGPT next to Google. And when I have a question now, I look at ChatGPT. I wonder how many people have done that already. Because ChatGPT is leaps and bounds ahead of Google. It gets you the answer without a hurdle. Google has to move fast, I argue. Okay? Major industries are about to be disrupted by new business models, which at a fundamental level are focused on moving bits of data. That's all you're moving, ones and zeros, and you're not moving people, you're not moving physical goods, you're not moving your employees. You can grow firms at an unprecedented pace if all you have to do to create a successful business is move bits. And so many businesses are focused on moving bits through the built infrastructure. So major industries are about to be disrupted. Major. I look at entertainment. I look at banking. So many. So many. We have to be so careful. So careful. Revolutions are still happening. Modern day businesses are productivity machines, regardless of macro. if you invest in a productivity machine that whose costs are reduced by say 90% a year in the case of some of these technology, macro doesn't matter in that case because you're invested in a productivity machine. Businesses are productivity machine. Another fundamental thing, deflation is coming. Inflation is not the problem, it's deflation. There's going to be more goods and services ever created. More goods and services are going to be created than ever before. That's the story of humanity, by the way. And why is that? That's because we have lean, data-driven, not human-driven, lean, i.e. not a lot of slack, data-driven resources, businesses. And I believe that those goods and services that will be created, that will be so abundant, I believe that they will not show up in GDP figures. They won't. They won't. And so, because our entire world economic system is rooted in Keynesian economics, they're going to try to print ever more money to try to have GDP, to try to have the numbers show that you have GDP. And I'm not sure, this is to tell you how bullish I am on innovation. I am not sure they will be able to print money fast enough to catch up to the amount of value that's going to be created. Think about Chat GDP. I could make a bet that Chat GDP has written more poetry in an hour than the history of poetry. That's one of the main use cases, right? Poems. There's been more poetry written by ChatGPT in an hour than in the entire history of the world. That's not showing up in the GDP figures. You're not hiring poets, right? What happens when generative AI gets so good that all you need to do to make a movie is copy and paste an entire book and click send, and then you have a whole movie in 20K definition given back to you based on that book. And if you don't like that movie, if you don't like anything about the movie, ask ChatGPT something more specific and they'll rewrite the book. Not ChatGPT, but generative AI. So in conclusion, we are still in the roaring 20s. And that's the topic of a new video. We are still in the roaring 20s. Innovation is still moving at an unprecedented pace. And because the market is so short term, we are not allowing ourselves to see it. But this is a great opportunity for investors. This is a great opportunity for investors. And so I hope I'm sending some hope out there in this holiday season. And thank you so much, for watching my video. This is obviously just entertainment, not investment advice. I hope this video was entertaining. Thank you for your support. Don't forget to like and subscribe and beat the denominator. And I'm fully aware that my opinions are not widespread right now. But that's my YouTube channel. So I'm just gonna say what I think. So thank you so much, and follow me on Twitter if you can, beat the denominator. Thank you so much, and I appreciate you watching. Thank you. Have a great day. Have a great holiday.